Hello, everybody, and welcome back. Today, my guest is James Veneau. Jim is the head of Asian fixed income at AXA Investment Managers. And today we want to discuss recent developments in the Asian high yield market. Welcome, Jim.
Thank you. Nice to be here.
Jim, the Asian high yield bond market has quadrupled in size over the past 10 years. What makes the segment that interesting currently?
I think that rapid growth in the market is indicative of rapid economic growth in the region, and that certainly has attracted investor attention. I think what's also attracted investor attention is the fact that there has been historically a fairly meaningful spread premium in the region, and so that has led to favorable relative value comparisons with other regional high yield strategies.
Hi there. Just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
To what extent has the enormous demand affected yield spreads in the region, and what potential remains for Asian high yield bonds after this run, and especially the strong last year's performance?
Yeah, so the buildup in demand that you mentioned is a relatively recent phenomena. And I think that is a function of sort of an acknowledgement of the growth in the region that had predated in the past decade. And then more recently, it's a perception that's formed in terms of the COVID outbreak and Asia's recovery from the COVID outbreak and the favorable perceptions that have gone with that. So as a result, we've seen a fair amount of external investor interest into the region. And one of the byproducts of that has been with the additional demand, a level of spread compression. What's important to distinguish, the spread compression is not completely even across all sectors and all issuers. So while Asia has generally done a good job at containing COVID and then recovering from COVID, particularly coming out of the Chinese market, that recovery has been fairly uneven. And there are sectors and issuers that have been impacted and have not tightened as much in terms of spread compression. So that means, as we look forward, there should still be some opportunities here. There are also a fair amount of risk remaining. In terms of the uncertainty regarding COVID and the recovery around that, the surges in COVID and then subsequent recovery.
So let's have a deeper look into how COVID-19 has changed the Asian high yield segment, and especially in terms of credit quality, yields, and default rates.
Yeah, so as I started to mention previously, COVID's clearly had a big impact in the region, as it has globally. That impact has been fairly uneven. Some sectors and issuers have either not been impacted or actually have benefited and have been able to capitalize on that and maintain strong performance, or upon impact recovered fairly quickly. In some sectors, that has not been the case. There has been a fairly substantial negative impact, and that has led to a deterioration in credit quality. And we've seen that in terms of the bond performance, in terms of how rating agencies have reacted. They haven't been necessarily willing to forbear. But what we haven't seen is an excess of default increases. And I think that's largely a result of, as we're all aware, there've been fairly high profile stimulus programs and liquidity injections into the market. And I think that has been highly beneficial to keeping us out of a scenario where defaults have excessively spiked.
So we've seen the first rate hikes in the US. What is the situation in Asia, and what impact would interest rate hikes have on Asian high yield bonds?
There was, if we go back to the beginning of the year, a fairly noticeable spike in U.S. Treasury yields. In fact, we went from a level of just above 1% to close to 1.8% And that was, given the short period of time, that was fairly rapid in a recent historical context or a recent cyclical context. If we think of the election in the fourth quarter of 2016, we think of the taper tantrum, we were starting to get into that sort of territory. But very quickly, as the yields approached 1.8%, they then sort of backed off and have receded. And so we've had, a fair amount of, stability, range-bound sort of levels for treasuries. So in that context, the impact has not been that meaningful in terms of market impact. The market impact has been much more meaningful, just as we were discussing in terms of COVID and the impact on credit fundamentals. Now, if we get into an environment of rate rises as sort of the treasury market digests the level of liquidity in the market. So in general, there's a number of theories as to why rates haven't risen given the huge amount of stimulus. And one of those is, again, it's technical. There's an increase in deposits in banks, and those banks are buying treasuries, and therefore the yields are suppressed, at an abnormally low level. Should that turn around and should we get into a rate rise environment, typically in the Asian high yield market, the areas that are most impacted are the sovereign bonds, longer duration sovereign bonds, and then sort of the corporates of those sovereigns, for example, Indonesia, that might move in sympathy. But by and large, corporate high yield bonds shouldn't be that impacted by a rise in rates.
How have you changed your portfolio allocation in Asian high yield since COVID-19 broke out, especially in terms of country and sector allocation, but also in terms of quality and maturity?
Yeah, I would say that we have mostly been more defensive in our positioning, which implies we've been more selective. So more looking for higher quality names, names that still offer some bit of relative value, but names that are not going to be either sensitive to risk sell-offs, so sort of what we would call our high beta names, or names that are going to be fundamentally impacted. Now that's challenging to do if you think of, that this is a universe that is high yielding and so covers the rating spectrum of sub-investment grade, so double B all the way down to triple C. So, most of the companies in our investment universe are going to have some level of exposure to, either, the macroeconomic environment or competition or regulation. And so the COVID environment is going to be challenging even for the strongest of those companies.
Which areas do you currently see investment opportunities opening up for Asian high yield bonds?
So there are a couple of areas that we remain fairly strong interest in. One is for ESG reasons, the Indian renewable sector, which has in the past few years undergone a fairly rapid growth. That appeals to us because this is a strategy, Asian high yield, that even though it's grown very rapidly, the growth has been very, very focused on China, and in particular China property. So whenever we have an opportunity to diversify outside of the China property sector, we're going to take a close look at those sectors. So Indian renewables certainly, as I was saying, from an ESG perspective, are very attractive. It's not China property. One of the downsides, though, is we're not the only ones who have those considerations. And so there's a high demand for those bonds, and therefore they tend to be expensive. Now, coming back to China property, we still remain largely constructive on the sector because this is a secular story, a secular growth story, one in terms of urbanization and income growth. Now, China property is not necessarily COVID impacted. It's COVID impacted like any sector in the economy is going to be. What's been impacting China property lately is more the level of government restrictions and policies designed to curb growth. And so that has caused a lot of disruption and displacement within that sector. And so even though that has increased volatility, it's also created opportunities. So it's a sector that has always offered a high baseline level of relative value. Now, with the dislocation, there's opportunities in higher quality names. So this is a sector that we're going to continue to have a high degree of focus on.
So we've seen this spectacular Evergrande case in China. So do you think this will be a singular event, or do we have to calculate that there will be more such property companies coming into crisis?
The issues that impact Evergrande are largely specific to Evergrande. There is an element of sector pressure with Evergrande, to the extent that Evergrande is a highly leveraged property company that has put it afoul of the three red lines of the government in terms of trying to manage the average quality of the China property developers to a higher level. So the case of Evergrande is very high profile because Evergrande is a large developer. They're a highly leveraged developer. So there's a lot of exposure across the economy, particularly in the financial system to Evergrande. So the Evergrande situation is still ongoing. The bonds are priced at deeply distressed levels. So far, there's certainly been a spillover impact, and it's as you would expect. It's sort of the riskier names have experienced a higher level of volatility. But just the point I was making earlier, that that the issues that are impacting Evergrande are Evergrande specific issues. There's a limit to how much spillover impact it can have across the sector. So if a specific name is not in any distress, has access to funding, sure, the bonds might trade at at a higher level of volatility. But if, as long as the company can continue to operate, can continue to develop its products, can continue to sell its property, and that's showing up in the results, then those names are going to have some prospects for recovery and strong returns going forward.
So this was James Veneau from AXA Investment Managers. Thank you very much, Jim, for being with us here today and sharing your insights.
My pleasure.